add these 40,000, 95,000, 15,000. So answer total 150,000. Now you need to find out percentage of total market value. And how you calculate that? 40,000 divided by 150,000. Here, answer is 0.267. You can also round off 27%. Okay, it's up to you. It's 27.6%. You can also round it out, round about to 27% as well. So there would be no error in that one if you do that. But let's be precise here. So the precision is going to be 26.7%. 95,000 divided by 150,000, answer is 63.3%. And if you multiply with the price that you paid, 120,000, answer would be 75,000 for building, 32,040 is for land, and equipment is 10%, so 12,000. So if you add, it must be equal to the amount you paid, right? So that was the answer. So this is called the RSV method, relative sale value method. Okay, for the second learning objective, capital expenditure and the expense, the difference between expenditure and expense, we'll talk about after 10 minutes break. Okay, let's have a tea break for 10 minutes and then we start from here. Okay class, welcome back after the break. So let's distinguish a capital expenditure from immediate expense. So let's just talk about that. Here we go, yes. So a capital expense or capital expenditure increase the asset's capacity or extend its useful life. So anything that you spend and it increases the asset life for more than 1 year, we call this is a capital expense, right? Capital expense means it is not going to be expensed, so this doesn't basically match the matching principle, right? The matching principle was that the expense should be expensed in that period in which it belongs, but the capital expenditure, it's life for more than 1 year, so we should basically divide it into some periods. Okay, this is from 1 year and second year, and then we expense that. Okay, so basically capitalize mean cost is added to an asset account, not expense immediately. Because of the long-term nature, it is not going to the income statement, it is going to the balance sheet, right? For example, here recording of a asset capital expenditure. So for example, major engine overhaul. Who messaged me? Okay, Anthony, I got your message. Okay, and then modification of the body of a new use of a truck, right? Additional storage capacity of a truck. So this is called that they extend the life of the truck, right? For example, the truck life was 5 years, but after 4 years, you did a major, repair, engine overhaul, new body, and now it can last for 10 years. So that expense is not going to the income statement. That is capital expenditure. That will go to the balance sheet. Okay? So ordinary expenditures are, for example, repair of transmission or other mechanism, oil change, lubrication, tire puncture, this kind of stuff, replacement of tires, windshield, paint jobs. So these are called ordinary repairs. So these repairs will directly go to income statement. And now measure and record depreciation on plant. So from here, our real discussion starts. So depreciation basically is a process that allocates a plant asset cost to expense over its life. So some says that it's a wear and tear. Some says that it is a reserve account. Some says that it is for you know it is for building some separate cash from others for other assets, but it's not. It is the cost of the asset you spread across its useful life, and you expense it on yearly basis according to the life. We'll see that. So it allocate cost against revenue the asset helps earn each period. Depreciation expense is reported on the income statement, but not the accumulated depreciation. We talk about that. Accumulated depreciation is basically the nature of the accumulated depreciation is it is contra asset account. For our understanding, we created this account so that we know that how much this asset is depreciated, how much left, because in a company, there is not only one asset, there are thousands of assets. So we want to know that how much this year is our depreciation expense. They are not just one laptop, not just one car, not a one AC. There are maybe 1,000 ACs, 1,000 laptops. So how you know that which laptop is going to be obsolete, or is cost going to be like obsolete, because no one laptop is purchased on the same date. Some are purchased in previous year, some are purchasing right now, some will be purchased after a year, right? So there's a different purchase time period. So we want to know that how much is the depreciation on our total assets. So that's why we created accumulated depreciation contra asset account. So that's why it is shown on the balance sheet. But depreciation expense, focus is on expense. Expense will go to income statement. And we already know that land is not going to be depreciated. So remember, depreciation is not a valuation process. It's not a reserve as well. Do not mean that it is setting aside cash to replace assets as they wear out. It is just a valuation method. Sorry, it is just the allocation method, allocation of cost method. Okay? Let's just talk about the example here. For example, Boeing 737, it cost is $32 million. Its estimated life is 20 years, right? And now, annual revenue generate 9 million. 9 million it generated the annual revenue. Every year, the sales gonna be 9 million. So we use 1 year life of the Boeing 737, and we generated 9 million US dollar as a revenue. So we use 1 year of its life. So it's 1 year of its life is equal to, so 32 million divided by 20. Answer is 1.6 million. So we use is 1.6 million per year life, and we generated $9 million revenue. So this is the meaning of depreciation. It's not a reserve account. It's not a valuation process. We spread the life, we spread the cost on the life of the asset on 20 years, right? Every year, this 1.6 million expense is generating $9 million revenue. Now, how do we measure this depreciation that we came up here? There are different methods we'll talk about here. First of all, in order to know the depreciation, we must know 3 things. Number 1, the cost. And cost is that cost which we already discussed in our start of the lecture. The cost of plant, machinery, this kind of stuff. And estimated useful life and how much this asset lasts. 5 year, 10 year, or the life can be in terms of units of output. The airplane gonna run, for example, 500,000 miles, or this car gonna run 150 miles, right? Sorry, 150,000 miles, or some other years as well. So life doesn't mean that it is always represented in terms of years. Life can be in terms of units of output. Life in terms can be of machine hours as well. So it would be given on the question, okay? And the last one, which is very important, is the estimated residual value. We also call this salvage value. Salvage. Let's see that. What do we mean by salvage? Salvage. Salvage value. Or scrap value. Different books use different language. Scrap value. Right? So, estimated life, scrap value, or salvage value, here it is already mentioned here. So it is the cash, or at the end of the life, what is the value? For example, after 20 years of the service of this airplane, you can sell it for $500,000. So after its useful period, you can resell it for $500,000. So this 500,000 is your salvage value or scrap value or estimated life. The other definition, which is more of the finance one, which is expected cash value of an asset at the end of its useful life. And that is not going to be depreciated because that amount you are recovering. So that is not going to be depreciated. So what is depreciable cost? What is the cost that you need to spread over the life of the asset? Simple. Asset cost minus its salvage value or scrap value or estimated residual value. Right? Simple. So there are three methods which are used to calculate the depreciation. Number one, straight line method, unit of production method, double declining method. So we have the data here. The cost of truck, including commission, including taxes, everything is 41,000. Its estimated life is 1,000, which means after 5 years, we can sell this truck for $1,000. So right now its cost is 40,000. So straight line method says that you divide this cost evenly on the life, evenly on 5 years. So just divided this 40,000 by 5. So that would be the depreciation per year for the 5 year. Here we go. The straight line method, equal amount of depreciation assigned each year. So the depreciable cost is divided by the number of its life in years. Remember, in straight line, the life is measured in terms of years, and it gives you annual depreciation, not monthly. If you want to calculate monthly, then divide it by 12. 2 months, 2 by 12. 6 months, 6 by 12. You multiply that.